I don't know if you've been paying attention to the EV space recently, but things are getting tough out there. Tesla went gangbusters until 2022 and has since struggled. BYD, gangbusters until 2022 and has now struggled. VW went well in 2021 and has now struggled, but none are quite as bad as the company we're going to be looking at today, that being Rivian. Yes, you've probably seen their EV pickup truck. They actually beat the competition to the electric pickup market, and the reviews of the R1T were actually pretty good. I remember a swath of reviews coming out across the board in 2021 from some really notable names, but they were all singing the praises of the R1T. But when you look beyond the product to the business itself, things don't look so pretty. In fact, peak to trough, since the IPO, investors are down a staggering 90%. So if you invested $10,000 in Rivian back at the peak around their IPO, today you've got just over $1,000 left. So it's fair to say that investors are a little bit fed up, particularly when you see just last month the CEO unloading 70,000 shares worth around 820 grand. But the real problems with this stock date back to 2021, and this is when the company went public. Now, I want to paint the picture for you here because it's a little bit ridiculous. So on October 1st, 2021, Rivian filed their S1 form, which essentially tells the SEC they want to go through an initial public offering and sell a big fresh packet of shares to the public for the first time and raise some money. And that's when those shares begin trading on the public exchange. Now, a lot of companies do that. There's nothing out of the ordinary with that. But the other thing companies talk about in their S1 filing is their financial data. And this is where the cracks start to emerge, because despite the company detailing their amazing growth plans and their 2 revolutionary new EVs and their big partnership with Amazon to provide them with electric delivery vans, well, they also provided the company's income statement, balance sheet, and cash flow statement. And get this, for the 6 months ended on June 30th, in 2020, they had 0 revenue and a net loss of 377 million. And then in 2021, they had 0 revenue and a net loss of 994 million. So effectively, around the time of their IPO, they were burning through $1 billion of cash every 6 months. And at the time, they had absolutely 0 revenue to show for it. But it does get a little bit worse, because when you turn to the balance sheet provided in their S1, they only had $3.66 billion of cash, so they were around 1.5 years from bankruptcy, assuming nothing changed. So it wasn't looking good. So naturally, they had to turn to an IPO to rescue them. Just get the investors to bail you out. And that's exactly what happened. Rivian IPO'd in November of 2021, selling 153 million shares at $78 per share. So you multiply the two together, and that fresh new sale of shares to the public raised approximately $11.9 billion for Rivian. So it's not bad, right? Investors forked out $11.9 billion to aid the cash-burning company, which at the S1 reported burn rate of $1 billion every 6 months, gave Rivian an extra 6 years of cash burn before they'd be closing their doors forever. But this is where things start to get really wild, because raising $12 billion from selling 153 million shares valued the entire company at $66.5 billion. Think about that. The CEO has drawn up a document featuring 2 cars and an expansion plan. The company has made nothing so far, and investors have turned around and said, you know what? This has got to be worth at least $60 billion. For context as to just how much $66.5 billion is, for the same valuation, you could have United Airlines, Southwest Airlines, Domino's Pizza, and chuck in Formula One while we're at it, and those companies combined would equal the IPO valuation of Rivian. So this turned out to be one of the largest IPOs in US history. But unfortunately, it gets a little bit worse. Of course it does. This is 2021 we're talking about. Because while the IPO price was $78 per share, just after the first day of trading, the share price had rocketed up to a close of $100.73 per share, giving the company a market capitalization of around $85.9 billion. And fast forward to November 16th, the shares closed at a staggering $172, giving the company a market cap of around $153 billion. That's the same valuation of Comcast or Uber. That's how big we're talking. So what does this all mean? Well, when you have a pre-revenue company that IPOs and rockets up to a market cap of around $150 billion, it means expectations. Investors expect that while the company might not be generating revenue now, they most certainly will generate a lot of revenue in the near future. Well, let's see how that got along. Trigger warning if you're a Rivian shareholder. So let's start with revenue. As you can see in the quarters that have passed since their IPO, Rivian's revenue has increased until the plateau and slight fall since the third quarter of last year. But have a look at this. even Rivian's direct costs exceed the revenue they generate. And that hasn't changed over the years. Now, this doesn't include the sales teams and the R&D or anything like that. This is just the direct costs of Rivian building their vehicles, the labor, the materials, the machinery, the factory. Look at the most recent quarter, for example. They brought in 1.2 billion in revenue, but the cost of that revenue was 1.73 billion. Think of it another way. That's essentially me selling you a book for $12, but that book cost me $17 to make. That's bad business. But of course, it gets worse once you add in the operating expenses like research and development, as well as selling general and administrative. You end up with operating income of negative 1.5 billion per quarter. Now, I want to be very clear, that doesn't necessarily mean Rivian is going to be a cash burning company forever or the stock can't rise. It may turn out to be okay in the long run. We just don't know. But what it does mean, objectively, is that they're burning money. If you look at their cash flow from operations, since their IPO, they have been consistently burning over $1 billion per quarter. Also, quick shout out, if you're actually looking at learning how to read these financial statements or value stocks, and you just want a quick explainer on the whole stock analysis process, I'll definitely encourage you to check out Introduction to Stock Analysis over on New Money Education. I actually got feedback from a professor of valuation at Texas Tech University who said it was the best online valuation course he has ever seen. So if you're interested in learning the process, please definitely check that out in the description. But as I was saying before, Rivian is burning a lot of money, and that eats away at the cash on your balance sheet. So have a look at the chart of Rivian's cash over time. They raised a big chunk of money through their IPO, as you can see. But since then, that balance has just been going down and down. And that's a result of their business eating money. Listen to Hamish talking about this recently on our podcast.
On a cash flow basis, they're burning $470 million a month. $470 million a month. And get this, so after the IPO in 2021, they had $18 billion. So they did the IPO, raised some capital, and they had $18 billion in cash. 2021, yep. It's already down to $8 billion. So they've obliterated $10 billion of their cash in the space of 2.5 years.
But what does this mean for the business? Well, in simple terms, running a cash-burning business and watching the cash balance deplete over time means you're getting closer and closer to bankruptcy. When you run out of cash and you can no longer pay for your expenses, that's when you're done. Now, in reality, there are a few steps companies can take to prolong this bankruptcy. However, for example, taking out a loan or raising capital, aka creating new shares and hopefully selling them to new investors. But the problem with that is, if it comes to that, most potential investors have realized that you're pretty close to bankruptcy, so they'll only accept a cheap price if they were to buy some fresh new shares. And this usually equates to a lot of new shares being issued to raise the same amount of money, which then dilutes and angers the pre-existing shareholders. Now, going back to Rivian's balance sheet, as you can see, their business just existing at the moment is burning through at least $1 billion per quarter. And with a cash balance in March of just $6 billion, it shows that realistically, they've only got about 1.5 years left before their business is done. And that's a big problem for them because they also know that their next big revenue generation opportunity is the release of their R2 platform, a series of cheaper mass market electric vehicles now slated to begin production in 2026. Now, realistically, that doesn't give them enough time, as it's highly likely that R2 will instantly fix a $1 billion hole in their pocket every quarter. So this means a heck of a lot of stress for RJ Scaringe because it doesn't take a genius to figure out some other source of funding needed to be secured. And enter Volkswagen. So you may have seen this pop up in the news recently. Volkswagen Group plans to invest up to $5 billion in electric vehicle startup Rivian, starting with an initial investment of $1 billion, with the additional $4 billion expected by 2026. What does this entail? Well, the press release notes that this partnership will have the two work on a joint venture to create next generation electrical architecture and best-in-class software technology. But what it really sounds like is that VW is buying the right to use Rivian's in-car software. Rivian founder RJ Scaringe noted that Volkswagen is expected to use Rivian's electrical architecture and software stack for vehicles beginning in the second half of the decade. But he said the joint venture does not include anything with battery technologies, vehicle propulsion systems, high voltage systems, or autonomy and electrical hardware. But I'll tell you one thing this deal definitely does include. Well, it's a lot of short-term relief for Rivian shareholders as the proverbial funding can has been kicked down the road. Sure, they might ham up the press release to talk about production synergies and collaborative opportunities and joint architectures, but really this deal gives Rivian a much-needed cash injection for which they will have to give up their software know-how to VW. RJ Scaringe himself noted the capital is expected to carry the company through the production ramp-up of its smaller R2 SUVs at its plant in Normal, Illinois, starting in 2026, as well as production of the mid-size EV platform at a plant in Georgia, where Rivian paused construction earlier this year. And I said before, this was a big sigh of relief for Rivian shareholders, but have a look at the movement it caused in the Rivian share price. The stock initially bounced up a whopping 54%. Now, it has settled quite a bit since that initial surge, but even still, since the announcement, shareholders are still up over 10%. So there might be some light at the end of the tunnel for Rivian shareholders, but that's the problem with these pre-revenue IPOs. Oftentimes, you need a lot of things to go right for a very long time before the business performance catches up to the valuation. I mean, if you bought Rivian shares at the highs in 2021, you bought in at 150 billion valuation. If we assume Rivian could hold a PE ratio around 20 in the long run, you'd need the earnings to be around $7.5 billion in a year to make that a fair investment. Now, in Rivian's first year after their IPO, their trailing 12-month net income was negative $7 billion. And that's not improving very rapidly. In fact, in the most recent 4 quarters, they've shown net income of negative $5.5 billion. So not exactly what you'd hope to see as an investor 3 years later. Essentially, by buying the shares back at that monstrous 150 billion valuation, you are saying that you are willing to invest in this company, wait for them to work their way to profitability, wait for them to grow to around 7.5 billion in earnings per year, and then after you've waited all that time, then you hope they can continue growing, at which time you'll start to make some money. And the whole time, you know this company is in the auto industry, known for its capital intensiveness and sensitivity to the spending behavior of consumers. That was the equation. So as you can see, that's why I personally don't mess around with IPOs, but each to their own. I definitely do want to clarify that by talking about Rivian's business in this video, I do not intend to imply a buy, hold, or sell recommendation on their shares. In this video, I've noted why the company doesn't work for me personally, but of course, that doesn't mean the shares can't go up, down, or sideways. And of course, I don't know what's right for you. So please remember that any advice is general in nature and it might not be right for you. But with that said, I hope you enjoyed looking at one of the most brutal shareholder roller coaster rides that we've seen in a long while. And for you Rivian shareholders out there, I've got my fingers crossed for you all. But with that said, please leave a like if you enjoyed, and I'll see you all in the next video.